Hey everyone, and welcome to Talk ETFs. My name is Sumit Roy, and I'm Senior Analyst here at ETF.com. 25 years. That's how long it's been since Morgan Stanley was last in the ETF business. And now it's back. In February, the company launched a suite of new ETFs under its Calvert Research brand. And the company has plans to launch many more ETFs. That's why I'm so excited to be speaking with Anthony Rochte, the global head of ETFs for Morgan Stanley, about the firm's re-entry into the ETF space. Anthony, welcome to the show.
Great to see you today, Sumit.
So Anthony, I want to start by asking you about Morgan Stanley's re-entry into the ETF space. Why did the firm decide now was the time to get back into this industry?
Let me give you a little background just on the platform we're building, and then we can talk about the brands we have planned, including Calvert. But just to take a step back, we're in the initial phase of a build-out of an ETF platform. Our objective is multi-asset class, equity and fixed, multi-brand, and also multi-jurisdiction. If you look at Morgan Stanley Investment Management post-acquisition of Eaton Vance over two and a half years ago, we picked up additional brands, obviously active fixed income and equity from Eaton Vance, customization and SMAs from Parametric, and certainly ESG and a pioneer with over 40 years of experience from Calvert. So our initial step is a broad platform here in the US, and over time, we'll look to launch in Europe and other jurisdictions. And we selected Calvert and ESG as our initial brand, launching on February 1st.
Fantastic. And of course, your first ETFs under the Calvert Research brand are tied to ESG. Lately, we've seen some controversy when it comes to ESG. Some of the biggest ESG ETFs have seen big outflows this year. There's been this whole politicization of ESG. But do you think that the long-term ESG story remains intact?
The ETF platform we're building at Morgan Stanley Investment Management, the rationale and the logic to do this, Sumit, is to provide choice. Choice for institutional investors that we serve around the globe, choice for financial advisors and wealth managers, and also registered investment advisors, and even the self-directed through E-Trade, which was part of that acquisition that I mentioned earlier. Look, I've been in the industry, the ETF industry specifically, for over 20 years. The one thing I've learned is you can never time a market, and that's not our objective. It's not to launch Calvert and ESG for the next 5 to 10 months. It's, for the next 5, 10 years and beyond. So we're well aware that there's headwinds in ESG. But when you look at Calvert, this is what they've been doing for over 40 years. They're an industry pioneer in ESG and socially aware investing. So, we're very confident. We've heard loud and clear from the institutions we serve through Calvert, from financial advisors, that they're continuing to use these exposures, and they're quite differentiated from many of the competitors out there. Despite the headwinds that have continued in the first quarter of 23, Calvert saw net inflows full year 22, and we've continued to see positive momentum in terms of flows in the first quarter of 23. So again, this is all that Calvert does. And when we looked at the total addressable market for ESG investing in the US specifically, it was clear over the last 3.5 years, investors have voted and they prefer the ETF vehicle alongside mutual funds and SMAs. And again, going back to the logic, Sumit, it's just to expand choice, in ESG investing.
Now you have these first ETFs on the market, but how do you see Morgan Stanley's ETF lineup evolving? Do you intend to be a major player in this space?
We today manage over 1.3 trillion in assets as of the end of 2022. We service wealth managers and advisors through Morgan Stanley Wealth Management. We service government entities, sovereign wealth funds, and pension plans around the world, and also the self-directed investor through our E-Trade platform. So when you say a major ETF player, we're confident we're going to provide choice, and we're going to do it with the brands I mentioned at the outset: Parametric, Eaton Vance, certainly Morgan Stanley Investment Management, and as we've discussed, Calvert. So we want to provide choice, and I think Sumit, where we want to go is where we invest money today. And when you look at the best of Morgan Stanley Investment Management, it's primarily active management. And that's really, our plans as we look around the corner.
And where do you envision the demand for your ETFs is going to come from, Anthony? Do you think it's going to come from inside of Morgan Stanley, or is it going to come from outside institutions, advisors, and retail investors?
We have, a deep, robust platform with Morgan Stanley Wealth Management. That's certainly a critical partner for us. But, make no mistake about it, we're open architecture. These ETFs are available anywhere you can purchase an equity. So the 3 to 4 major wirehouses, independent broker dealers. I think the all-important segment out of the gate, and you know this as well as anyone, is the fee-only and fee-based registered investment advisor segment. Cerulli data looked at this full year 22, and today almost a third of the average RIA is allocated, their book of business to the ETF wrapper. And then when we look at the major wirehouse platforms, like a Morgan Stanley Wealth or a Merrill Lynch or even a UBS, the more fee-based, more advisory those teams are, the more likely they are to use ETFs. So I would say we'll continue to grow with the clients we serve. I know out of the gate with Calvert, we've had significant interest from a number of large institutional investors who know Calvert well for the rich heritage they have, as I said, dating back over 40 years. So, we're committed to this market. We're certainly excited, and we certainly have plans to launch here in the U.S. and globally down the road.
Finally, before I let you go, Anthony, is there anything else you want to add?
I would just reinforce our focus on active management in the brands that I highlighted earlier. I think many know there's been a regulatory change, certainly Rule 6011 enacted in 2019, really allowed additional active managers to enter the space. And we've seen an acceleration of growth in active, transparent fixed income ETFs, certainly on the shorter duration spectrum in full year 22. But we've also seen other brands enter the space. So we're very optimistic about active management in the ETF universe, certainly here in the US. And I think longer term in Europe, but the trend is real today in terms of active, transparent ETFs.
That's the perfect place to end it. Thanks so much for joining me, Anthony.
Thank you, Sumit.